Many of our stocks are down 80%. Some are down 90% from their peaks, which is just ridiculous.
Hey guys, welcome back to Library of Wealth. In today's video, we have the CEO of ARK Invest, Cathie Wood, giving us a market breakdown with deflation and negative prices coming in the last few months of the year. Wood believes the economic indicators all point to a recession, as well as the inflection points the Fed will need to pivot on. Cathie believes we're living in unprecedented times as we wait for interest rates and inflation to go down. Wood believes the drastic actions by the Federal Reserve are crashing the market. This restricts the flow of the digital commerce space, and emerging markets are already being terrorized by inflation, which is collapsing purchasing power. She believes that the current trajectory we're seeing now is only a precursor of what's to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
So we are very data-driven, very research-driven. And so many people ask me why I have such strong conviction. How could I have such strong conviction when these stocks are down that much? And it comes directly from our research. And if you don't think we are double checking and triple checking our research and our assumptions going into the research, and basically our clients and the social world is helping us battle test those assumptions. What we see as our stocks go down 80 to 90%, if we're right, we're seeing the total rate of return expectation increase for the next 5 years. So we keep our eye on that prize. And if the world, and if our research is correct and the world has not changed, we've just moved into a risk-off period with inflation and interest rates, the reason, and this move back towards benchmark stocks, the reason our stocks are going to be dumped, we wouldn't be selling our stocks. We'd be picking them up. And that's what we do. We average down during risk-off periods. And we also concentrate our portfolios towards our highest conviction names. So we've moved our flagship portfolio, ARKK, from 58 names down to 32, 33 names. And we're further consolidating in this risk-off period, but we tend to bottom out in that low 30s range. In fact, as we were reaching the peak in 2021, many of our stocks were beginning to fall below our minimum hurdle rate of return over a 5-year period. That number is 15% for the public portfolios. And as they were falling below that 15% mark, we were not raising the earnings or the valuations. We were selling the stock. So we've made some great calls, both macro and micro, and they are starting to pay off now, but we're still in a risk-off market. And I am seeing glimmers of hope. Our strategies are starting to outperform now on days when some of these big benchmarks don't. And that's what usually happens as we're coming towards the end of a bear market. At the end of the bear market, the saying goes, the new leadership shows itself. We're focused exclusively on a slice of the market, and it is up to asset allocators, not us. We're not an asset allocator. We're giving asset allocators an opportunity to make up for the massive short that we believe they have in their portfolios. That's all we do. So those who are saying this, and I've seen some wirehouses saying this, but if you go to their due diligence departments understand what we are. We are a slice of an equity portfolio, and it is up to advisors or asset allocators, other asset allocators, to determine how big a slice of the pie our strategy should represent. That's not our decision. Advisors know their clients better, right, than we do.
Sure.
And we just do one thing. We don't have to worry about asset allocation. We believe filling an unmet need in the marketplace. And yet many people consider what we're doing to be extremely risky. And it is volatile. It is volatile because the future is filled with uncertainty, whereas these benchmark stocks are more about the past and their past successes. So do you understand why? I don't understand why people say we don't consider risk, and you have to have a long-term investment time horizon and the stomach to deal with the volatility. If you need to look at your portfolios every day, and they will be able to look at their portfolios here every day now, and because everything will be marked to market every day. Now, of course, there will be liquidity events will pop the venture, just as a takeover would pop our public funds. But if you don't have that long-term investment time horizon and real conviction that the innovation that we're seeing today is going to create massive investment opportunities, if you don't believe that as a starting point, then you shouldn't be involved. Since February of 21, when our strategy peaked, and as you know, we're focused exclusively on disruptive innovation. So since 2021, our strategy has been destroyed, and any innovation strategy, and now more growth strategies are being sucked into this. So we're seeing the down rounds, and personally, I like starting businesses and portfolios during down times. We're nascent, and so we could average into what I do believe could be a set of significant drawdowns in the private world that has already happened in the public world. Now, the fund that we have launched is a public-private crossover fund. And sure, at maturity, our desire is to get it close to 75% private and 25% public to allow more liquidity. But right now, we're not near that. So we're getting close, but we will continue, if we get flows in, to use public stocks because we believe there is a bit of an arbitrage here, opportunity here. And we are buying into down rounds in the private markets at the same time. I also think, I want to make this clear, that the private markets have innovation more right in terms of valuation than the public markets do. Many of our stocks are down 80%, some are down 90% from their peaks, which is just ridiculous.
According to Cathie Wood, ARK makes all of its research easily available to the general public, giving her clients a level of clarity they can't find anywhere on the market. She added that the traditional banking sector does not deserve shareholders of innovation, and that the investment group would continue to reveal its financial structure. Wood advises the business in which she has invested to make significant investments right now to capitalize on the enormous growth potential. What do you think of Cathie Wood's interview on the current financial market and what's to come this year? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.